welcome to ICICIdirect. Joining us now is Aashish Wakankar, founder of EquiPoise Capital Management, to talk to us about his budget expectations. The union budget is around the corner and there has been a list of expectations from the industry and experts. Aashish, the 2021 budget was a growth-dominated budget and re-rated the market. Is there anything specific which should come in this year's budget that could excite the market? Do you think the government will announce a growth-oriented budget or populist, especially ahead of state elections? What is the key expectation here?
Thank you for inviting me. At EquiPoise Capital Management, we believe that the trend that has been set over the last 4 or 5 years, and the government has been on a fiscal prudence path all through and through with a focus on growth. I think there is no reason why there should be any deviation this year. One thing one needs to appreciate, and that's what we have as a view at EquiPoise, is that the market is actually having very low expectations from the budget this year, given the fact that gradual fiscal consolidation can be expected or is expected from this budget. What we had in late financial year 2020 and in FY 2021 was a fiscal deficit which went to a high of nearly 9.2%, which was basically in response to the pandemic, the special measures that had to be taken, or the spending that had to be taken to protect particularly the weaker sections of the economy, basically even the MSMEs. What we have in FY 2022 is a complete surprise in the form of economy reviving very strongly. I don't think many, including the global observers or global experts, were expecting this. So if you look at, and in fact, just a couple of days back, we had the IMF come up with its projections for FY 22 and 23, which is at 9% for both the years. If you look at US and China, they fall off the cliff in 23, FY 23. So that's basically, it's not the base effect which is causing India's economy to sustain a 9% growth, whether it is in 21 or in 22. It's basically some of the measures that the government has taken. I think the numbers are speaking for themselves. If you look at the tax collection, there is a strong tailwind over there. Basically, economic growth feeding it into the tax collection. There is tax buoyancy, right? So if you look at direct tax collection, look at indirect tax collection, GST, all numbers, I mean, we are running close to about 1.3 trillion rupees of tax GST collection for three months in a row. There is decent amount of tailwind, and the one number which I closely look at, and that number which really excites me, is the capital expenditure. I mean, many would have expected, and I think this is something that we need to appreciate. I mean, what you had in way back in 2009 as a response to the global financial crisis was all the major economies coming together and giving a stimulus which was consumption oriented. In 2021, you had a global pandemic, and again the global economies got together and gave a stimulus which was consumption oriented, excepting for India. India focused on a long-term tedious path of focusing on investments and investment-led growth, because investment-led growth will always have a lag effect on the economy. So a long-term painful path was taken, a complete deviation from the major economies, and I think we are today bearing the fruits or enjoying the fruits of those measures, those tough measures that were taken, which was investment-led path. So I think the one number that I keep tracking, and if that number is kept going even in FY 23 budget, and that is the capital expenditure growth. Capital expenditure in financial year 21 was up nearly 27%. It was up almost up nearly 30% in the financial year 22, and it's expected to close at that number, that is. And the expectation for 23, the market expects, if it is closer to 20% in FY 23 as well, I think the markets are going to cheer that. Another factor that one needs to appreciate and look at, what does the government do? Now, I just spoke about the tax buoyancy, right? So there is a decent amount of tailwind in the form of economy, which is a major surprise to others. The economy has come back really very strong. And despite the fact that one of the largest sectors, which is the hospitality or the services sector within the hospitality within the services sector, is yet to kick off. So that is additional, booster that is pending. But despite that, the economy is showing a 9% growth, resulting in decent amount of tax collection. So government is actually in a comfortable situation. The markets would actually look at whether with these kind of tailwinds in its favor, whether what does it do with the taxes, be it direct tax, be it indirect tax, be it there is a confusion, there is a fear related to capital gains tax this year. So there are fears in the market regarding STT as well. Right. Regarding wealth tax as well. So all these kind of unconfirmed rumors that are causing fear and anxiety in the market. I would personally want to believe that if the taxes, forget tax cut, if the taxes are even left untouched this year, because you have tax buoyancy, you don't need to touch these. Even if that is left untouched, I think the markets will cheer this budget. And beyond this, I think the markets would look at what is the divestment trajectory or the strategic divestments that are going to take place this year. Because the one number that really haunts, if you look at the government budget, is the expenditure, is the revenue expenditure, and specifically within the revenue expenditure is the interest component, which is close to about 8 lakh crores, 8 trillion rupees. So that's a significantly large number. We are on a glide path, on a path down, because the expenses related to the pandemic are going to come off now slowly. So you don't have a pressure. You have tax collection, which is strong. So how do you shore up your finances rather than taxing, raising taxes, which is the easiest thing that governments like to do. But if that is left untouched, if there is clarity on the inclusion in global bond indices, Indian bonds or Indian securities on the global bond indices and on the strategic divestments, if these small things, if a couple of things are looked at, leaving taxes untouched, divestment trajectory, and the government bond indices inclusion, I think markets are going to just look at these and the expectations are around that.
Aashish, I'm just going to play devil's advocate here. So while you've highlighted a whole bunch of positives that might work in our favor this year, we can't take our eyes off the fact that the current account deficit is a worry. The CAD is at an 8-year high. The backdrop right now is global central banks currently tightening. Inflation is a huge worry. The currency could be a concern if things continue to play out the way they are right now. What happens in those circumstances? How do you think the government will indicate the plan to navigate at this budget?
Yeah, thanks for this. I think I should have spoken about inflation in my opening remarks. See, inflation is related to basically global commodities, is related to your supply chain management disruption, supply chain disruptions, be it related to semiconductors. So all these factors are definitely playing out. Over and above that, you touched upon rate hikes. So global central banks and even RBI would look at going down that path. But the basic difference between then and today, so when I say then is I'm looking at 2007, 2009, and today, is that economy at that time was at its peak. Rates were not at the bottom. Over here today, rates are at the absolute low. Economy is just about turning it's like turning the trough. So you have these positives in your favor. So at a time when economy is reviving, a rate hike or cycle coming in play along with that is not something that can actually disturb the markets. Using taxes, basically, or hiking taxes to take care of resource raising or financing the budget, if that can be stepped aside this year, I think the markets would just look at that, because Tax collections are decently running at a high. The collection, and please, one more thing that one needs to appreciate is that cess, which is on petrol and diesel,
Right.
it has been throughout this cycle at a high. Despite that, the economy has revived. So it is only now that you cut the cess on petrol and diesel marginally. So the revival of the economy is despite all these challenges that were there in front of it. So I think inflation coming back is not something that is going to affect only India. Inflation is because of global factors. And why should we worry? Because I look at one indicator. I look at the people and the long queues at the petrol pump. Yes, petrol prices, diesel prices have been at a high, but has the traffic jam on the road gone down? Have the queues at the petrol pumps gone any lower? No. People have been, benefiting directly because of the growth, the GDP growth that the economy is witnessing. So there are many levers, enough that can be done. But I think raising taxes, that's the point, the only point I'm trying to highlight over here is.
No, you're absolutely right. Yeah. Aashish, we'll move away from taxation, and I just want to understand from you right now, any specific sectors you think that could be in focus next week? I mean, will the government focus on sectors that generate more employment? Because at the end of the day, it's all about employment and consumption, or sectors that have been most affected by the pandemic. How do you think this rope will be walked?
I look at one aspect. I look at the market where it was on 31st January 2017. I'm just using a 5-year period to look at the markets. And if I look at the market, the Nifty 50, it was at 8571 on 31st January 2017. Today, we are plus 17,000. Despite all the fears that are there, whether it is related to some geopolitical issue in Ukraine, whether it is related to inflation, whether it is related to central bank rate hikes, what have you. I want to leave a message over here for investors, and it's something that I had even spoken during the calls that I had, internal calls, whether it was in December, whether it was in Jan. One should be looking at markets with a long-term view. Just take a look at what has happened in the last 5 years. I mean, it's amply clear that the impact of the budgets is on a secular decline. You have seen the markets out in 4 out of last 5 budgets. On the day of the budget and the year following the budgets, the markets have given a strong positive, return. It's a 15% CAGR that we are talking of. Look at one number. That number is capital expenditure. Capital expenditure growth, despite the pandemic, was at 27-30%. So if you look at a 3-year CAGR, you're looking at close to about 25-26% of growth in the capital expenditure. Anything and everything around that, because a country like India cannot have consumption-led growth. Consumption-led growth in a capital-starved, in a capacity-starved economy will cause inflation. When you have investment-led growth, which has a supplementary impact on consumption, that is the correct model. And I think government during this pandemic has demonstrated that. World continued with consumption-led stimulus, India moved to investment-led stimulus, and we are benefiting from. So as long as the government remains focused, the sectors which directly and indirectly, whether it's the first or the second derivative beneficiary of the impetus or the efforts, those will be the sectors which will continue to benefit. There is one sector which I believe is in for a structural change, and that is a function of Atmanirbhar Bharat or Srijan, and that is the defense sector. Hitherto, we have been seeing massive effect. At one point of time, a country, a democracy at the size of India was the world's largest importer of defense equipment and defense machinery. Today, we have fallen down. Today, Saudi Arabia is number 1. So a strategic path, clear direction, number of items being brought down, the clear instruction that, after 2025, you cannot import a certain specified number of designated items within defense. I think this money which was going out of the economy in the form of imports will be recycled, is getting recycled, and the beneficiaries of that will be a sector, listed, unlisted, everybody. Who will benefit because, so some of these changes which are structural in nature, effort on capital expenditure is, I think, the most important part of it. Effort or the focus on Atmanirbhar Bharat or self-reliant India, trying to revive manufacturing and industry within the country.
Right.
I think these are the sectors around these will be the first or direct beneficiaries, and the consumption, which is a second derivative of this, will be the next beneficiary. So you will have the services sector, you will have the hospitality sector, automobiles, which will benefit, but they will be the second derivative of that. I think the two things one needs to focus on during this budget is what does the government do as far as divestment program is concerned for raising resources? What does the government do as far as inclusion of Indian bonds in the global bond indices?
Right.
And believe me, I firmly think that increasing taxes by any way or trying to use taxes to shore up financial or resources will not be appreciated by the market. So by and large, these are some of the things that I'm looking at.
That is an area that's non-negotiable, I think, increasing taxes. I think for now, even from a direct tax angle, the only way to boost consumption would really be any sort of significant announcement coming in for salary class to cut taxes, even the STT, LTCG. So lots of action on the tax front is the expectation, right?
So I don't really think there is an expectation on cut. If it is left untouched, even that will be cheered and that will be given a thumbs up. So because one thing is very clear, you have a fiscal deficit which is running at a significant high. In financial year 21, it touched 9.2%. We are expecting it to be close to 6.8%. And if along with the LIC IPO proceeds, if they go through, if the IPO goes through, then you will be close to around 6.4% of GDP. In FY22, so there's a sharp drop. I mean, just take a look at what was the path. I mean, from FY16, FY17 onwards, we came down in FY19 closer to about 3.4%. Fiscal deficit is a percentage of GDP.
Joining us, the first one, financial.
Because of the pandemic, it has shot up. We are back to 6.8 or maybe 6.4. We'll close somewhere around that in FY22. We'll go down to 6% thereof in FY23 purely because of two factors: lower expenditure, which was specific to pandemic, and tax buoyancy. So these two things will go in your favor, but we still are a way distance away from 3.4% that we were, and that was a commitment of bringing it down to 3%.
Right.
So, as per the measures accepted, so we still have a long way. So even if we close in FY23 at 6%, we still have a good 3% to correct. Given these challenges, to expect tax cuts is, I think, I mean, from my interaction, I've been speaking with a wide range of people, whether it is from the same fraternity, whether it is the offshore fraternity. I really did not come across, and my own personal feeling, I don't think tax cut to don't increase itself is good, because you have ample resources, ammunition available to raise resources, financial resources. One aspect where the government probably can get more aggressive is divestments. I mean, great. I mean, you're doing great by pushing and taking measures. It's commendable to get on the global bond indices. I mean, the economy of the size of India with such a large manufacturing base, not inside the global bond indices, was an aberration. It's getting corrected. I guess in the calendar year 22, you will see that. But what about divestments? I mean, we got the elephant out of the room, which was Air India. But that really did not bring in resources. So what will happen is the incremental outgo in the years ahead has been stemmed, but the actual cash inflow for that, there is enough. So just take a look at Nifty PSU index for the 3 years period. Nifty PSU index has underperformed the Nifty 50 index by a factor of 2. It's almost half. So the government portfolio, if somebody is managing that portfolio, the investors are going to ask this question: hey, look, the market has given 2x% return, you are giving only X% return. Why am I still invested in this portfolio? divestments have to, or strategic divestments, and the clear path is something as a way to raise financial resources is something where the government probably needs to get more aggressive. Other than that, I think expecting tax cut, there will be, some announcement I'm expecting on the next GST meeting. But to expect cut in direct, indirect, capital gain or STT related taxes, I think it would be unreasonable for simply because we have a long distance to go where we go back to the 3.5% fiscal deficit target.
Right. Very lastly, Aashish, then how should an investor position themselves ahead of the budget and of course on budget day, and how would you play it out post budget?
A good question. This is my favorite question, what I like to say, and this is something that I have said in the month of December and Jan when I addressed the sales team and the distributors within the ICICIdirect fold. Don't time the market. Investment and trading are two different things. So if you call yourself an investor, investment is an ongoing, continuous process. You earn, you spend something, discretionary expenditure that you need to survive, need to take care of it. What remains is saving. Savings put to work is investment. So every month you get a paycheck, every month you spend, and there is an amount which is left behind. Put that money to work in a smart manner, in a systematic manner is all I would say. And to bolster or to prove that point, please take a look at where was the index in 31st January. I'm just using a 5-year period. 31st January 2017, where is the index today? There were 5 budgets that were presented during this entire period. What has happened? The markets have taken it in their stride, have seen the positives, and a country like India, which on the one hand we say there is inflation purely because of this is a country which is capacity starved. This is a country where infrastructure challenges are there, right? That is the reason there is inflation. I mean, we go on the road, there is traffic jam. We go to the airport, there are. I mean, you go at 5 o'clock, 2 o'clock, whatever time. In Mumbai airport is full of it. It's like a fish market. So what does it say? That capacity relative to the demand is way low. This country is in a mode of capital expenditure. The country is in a mode of capex. The capex is spent as long as it remains strong, as long as it remains in a secular up direction, as long as it is a focus of the government. I think rather than getting fixated with budget announcements, which are more, which can have a short-term impact. But over the long term, I think we have seen how the markets have panned out, how the economy has performed. I think that should be the focus rather than trying to see. Yes, take a look at these numbers. What is the government? So very clearly, the government has shown fiscal prudence. So I don't really think they will deviate from that. There is no reason for me to believe that, because at the end of the day, future lies in history. And the only way to figure out what is going to happen tomorrow or what is going to happen in terms of a person's behavior or an organization's behavior, I have to see what that organization has done over the immediate past. And I look at the last 5 years. I look at even during the most difficult times, capital expenditure continued.
Right.
So I would rather not say what will happen on the day of the budget. What I would say is that investments has to be a part of your daily or monthly or weekly habit. Continue to do that. Look at where the markets have gone. I think 15% CAGR last 5 years is there. If you think adjusted to the risk that you take, if there is an instrument, if there is an investment product that you have which is better than this, obviously you should take a look at that. But if not,
now fair point. I think systematic, disciplined investing for the long term is what an investor needs to focus on. Budgets come, budgets go. They've almost become non-events now. But the significance still remains in sense of what will be the challenges that the finance minister will be faced with and what will be delivered at this much anticipated budget. Thank you very much, Aashish. I think you have a point to make.
Yes. I want to say one thing. I think it's one of the most difficult jobs in the world, because what happens is when the budget is presented, all the constituents of the society or the economy have to be pleased. It's almost impossible to do that, because what one needs to appreciate is that your expenditure is my income and my expenditure is your income. Right? So
You
if
can't please
both
everyone.
of us feel that our incomes have to go up and our expenditures have to go down, and this the finance minister has to do, I think how does one do that?
No, it's not an easy job.
It's the toughest job in my opinion.
It's so much riding on her shoulders in that sense. But thank you, Ashish. Great talking to you. That was, of course, budget expectations coming in from Ashish, from, of course, the finance minister, and the budget will be rolled out next week. Thanks for that.
Thank you very much.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.